Good morning, everyone. This is Darius Dell here to present our macro bundle Q&A live. I'm joined with Imran Lakha of Options Insight, and boy, are you guys in for a treat. How you doing, Imran?
Hey Darius, how are you? Thanks for having me.
I am wonderful, man. Thanks again for joining us this morning. So, as you guys all know, you guys have all Options Insight on finance Twitter on FinTwit. Obviously, truly one of the world's best sort of teachers at options market strategies, dynamic hedging activities, how to eliminate costs from your options trades, and incorporating all of that within the context of obviously a very educated, deep view on global Wall Street. So, thank you so much. I appreciate it. Walk me through your background, man. Talk to me to sort of how you got here, how you wound up in the spot that you are
Oh
in.
wow, okay, yeah. I've been around for a while. I started my career in 2001. Would you believe? I started at Credit Suisse, first Boston, in London, as a junior on the equity derivatives side. Kind of grew up there, learnt my trade there. Ended up going to Merrill Lynch in 2007. Traded through the financial crisis there. So obviously through the takeover, as when Bank of America kind of took them over. Equity vol. So I actually surprisingly, I was one of the few people who had a good time in 2008, unlike a lot of people. And then kind of ended up running the desk there at Merrill for a few years. Then took some time out, traveled the world with my wife, which was fun. Then came back at Citibank in around 2013. Ran the desk there for a while. Had a short stint on the buy side as a macro PM. And now I teach people the dark arts of options.
About the dark arts is that you're actually shining some light on it. You and Brenda Chu over at Spot Gamma doing some excellent work. Obviously,
Mm,
Sergey, and I'm definitely going to mispronounce your name if you're listening, if you're watching.
Kachuba. Kachuba.
It's good. No, no, no. I know Brent. I'm talking about Sergey. It starts with a P. But no, you guys are. I mean, I consider you guys to be part of this sort of what I would consider to be a very elite community of people. Obviously, with Jim Carson, I'm blanking on Jim as well. So, but a very elite community of people who a know what the hell they're doing, and b are passionate about explaining it to people. Because I personally struggle with understanding and comprehending derivatives, and so kind of walk me through how you incorporate derivatives in the context of your macro trades and how you fold macro into your investment process.
Sure, sure. Yeah, I mean, it's so, I've got various sort of portfolios that I run for myself. So I've got obviously a long-term portfolio like everyone, pension fund, let's call it. And that's more of an asset allocation game. So that's where I really utilize a lot of your work, right? And, trying to figure out what regime we're in and what the right asset allocation mix is and those sort of things. So relatively low frequency, made some over the last couple of years, had to make some big pivots in that. Examples would be gold back in April last year was a big one for me. I went like long 50% gold, which obviously, I'm not recommending that in a portfolio construction, but I felt a lot more comfortable in last April to be in gold than I did in some of the equity markets because I just wanted to see what was going to come out of this situation, right? This kind of global demand and supply shock. And then, another pivot would be, getting out of gold and more into industrial metals, post the vaccinations, things like that. Also picking up a few of these really beaten up value sectors before the vaccinations got announced, like that. So those are the sort of things I'm doing there. Also dabbled a bit in crypto in my pension as well, like allocated into some crypto exposures, but that's very much just kind of try and hold it for a long period of time. Then in terms of the more tactical books that I run for myself, obviously I've got options, experience, and knowledge. So the more tactical stuff is where the options come into play. So sometimes it's just straight, futures or delta or whatever you want to call it, delta one. But then often, you can obviously leverage your views, your short-term tactical views, using optionality better, right? And that's where you can kind of take limited risk and make, 5 times that kind of thing, right? So that's where you try and look for tactical, and a lot of it is kind of technical analysis based, mean reversion, looking for trend breakouts, things like that. The type of stuff a lot of people are doing out there, but knowing how to implement a trade using optionality to kind of improve your risk reward, right? So that's kind of what I'm trying to do. And that's particularly worked really well in crypto land, right? So, I mean, a big thing that I got into last summer was trading crypto and trading crypto options specifically. So whilst I allocated some capital just to straight crypto as a hodler, I kind of complemented that with a bit of options trading on top, and that kind of helped me grow that portfolio and really, take advantage of some of the vol opportunities that existed.
In terms of your capital, and might be too much, but what percentage of your capital are you allocating towards your tactical strategy relative to your sort of longer term asset?
Yes, the tactical is relatively smaller. I would say, order of magnitude, maybe 20%, something like that. So I'd say 80% is the long-term strategic kind of asset allocation, and then 20% is like playing around. Right now, crypto was playing around, but it kind of exploded on itself and made it a lot bigger. So I'm letting that ride. So that tactical pot got a bit bigger by itself, as I'm sure anyone who's invested in crypto in the last 18 months has kind of experienced. But if you're a big asset manager who runs other people's money, yeah, you might need to stick within certain boundaries of how long you can be in crypto because of the super high vol that it is. But the reason you're getting into crypto as a retail guy is because you want it to go 10x or more, right? So there's no point like shaving it off when it doubles, because you want that exponential, you want that kind of leverage that you get from, the reason, and I've got a video on my YouTube channel about why I was buying Bitcoin, and it was all about the fact that Bitcoin, once you get your head around the fact that Bitcoin is a call option with no time decay, right? Then you don't get scared of it anymore. When you're an options trader and you're like, so you're telling me this thing could do 10x like a call option, but I don't pay any time decay. And actually, it's more likely to go up through time because of the deflationary nature of it, right? And the fact that more people are adopting it and the supply is not increasing, then it's a gimme trade basically, right? So that's how I got my head around getting into Bitcoin, because it's a call option with no time decay. Yeah. Yeah, exactly. Last summer wasn't one of those. Yeah, exactly.
So that's what we're trying to do. Obviously, you and I were talking this on in the preamble before the show. Kind of like, one thing you were saying, hey, this is something that I think you could enhance your product with respect to kind of call overriding and things of that nature. So walk me through how you would actually implement some of those strategies with respect to our probable range process.
So I'll start by saying that systematically using options, if you're a systematic buyer of options, you're probably going to lose money, right? So the most successful systematic users of options are the people who sell them, right? A lot of people aren't comfortable selling them. So the safe way to sell options is the strategy called call overwriting. When you own an asset, you own the shares or the underlying ETFs, in your case, it would be, you do that, and then you sell call options that are struck out of the money against those exposures, right? And the idea is you are collecting premium when you sell those options, and then if the market goes above the strike price of those options, your exposure will come down because you've given someone else the right to buy that exposure from you. Yeah. But if it's at the top of your probable range in your process, you don't mind shaving that exposure down necessarily, because you kind of would have done that anyway, right? So for me, it's like a way of, rather than you having to actively be the seller of your exposure and saying, right, I'm going to sell it at the top of the range, you kind of collect premium against it, and if it goes higher, then you get taken out of it, basically, right? So that would be a way that I would potentially structure that for your, and that's a yield enhancement strategy that is done all over the place by all the asset managers, and to enhance their yield.
Your product, that's what it is.
Yeah.
So
Yeah,
does that
exactly.
process work in reverse? Something's at the lower boundary of its probable range. Can you sort of put override, I guess would be the term?
Yeah, you can, but obviously the equivalent of that is to say it's called cash covered put selling, right? So if you've got cash in your account, then you can sell a put, and if it goes down there, you get delivered that stock. As long as you've got the cash in your account to pay for that stock, then you don't have a problem, basically, right? It's when you do it in size where you don't have the cash to take delivery of that stock, then you get yourself into trouble. Right.
Gotcha. So that you can, I guess, immediately execute upon delivery.
Exactly. You've got the cash there waiting, and you've picked a strike where you're happy to take delivery of that stock at that discounted level, basically.
Excellent, man. This is brilliant. Let's transition to some recent market dynamics. Obviously, that's where most folks are here. Something I was talking about, and again, my interpretation of a lot of what's going on in the options market, particularly with respect to dealer flow positioning, I would say is probably, let's, if you're a 10, I'm somewhere close to two. In terms of like
I think you're selling yourself short.
perhaps, yeah. Maybe I'm a three. We'll certainly give myself
Three and a half, three and a
let's
half,
say three and a
four.
half. Yeah. In terms of like, because I say this all the time, but that's among the most complicated things that are occurring in finance. Like for someone to turn on Twitter and assume they can understand dealer positioning, flow dynamics, gamma pins, and all this other stuff. I mean, it's the equivalent of like turning on Fin Twitter and understanding how the global macroeconomy works. You're not going to be able to do it. It takes years and years and years of real world
Mm.
experience to actually build up the knowledge base to actually be dangerous with this kind of stuff. And we're really grateful for folks like Imran and others in the community for teaching us and really opening their knowledge base to us because it allows us to speed up that learning process. One thing I was talking about last week, and you can certainly feel free to poke holes in it. I made the comment, towards the end of last week, was saying, "Hey, look, man, this market looks really pinned." Now, I couldn't tell you where the gamma pins were in price terms, but in terms of the realized volatility that we saw heading into OPEX, it was about as pinned as we've seen in months, if not, if not this entire year. And the reality is, I continue to say this, is that investors are very much bidding up the cost of put protection. There's obviously a number of bearish catalysts swirling around. You got margin debts back up there again. Obviously the accelerated tapering. We have COVID cases spiking on the northern hemisphere. There's a myriad of reasons. Obviously inflation, in being one of the big ones, in supply chain disruptions. So you could see that build up and put premium. You saw the shift and skew go from pretty bullish to start to get on the margin bearish relative to where it had been in recent weeks. And so I said, hey, look, this thing could come unpinned on Friday, and it looks like it did on Monday and Tuesday to some degree. Was that a correct interpretation? And if so, how could you have further enhanced that with maybe an options trade or strategy?
So, okay, so I'll tell you how I played it, right? So, not the week of expiry, which was last week, the week before that, the
Mm-hmm.
market was already realizing very, very low. So, it was already showing signs that it was gravitating towards that large pin going into expiry.
Yeah.
And if you looked at the open interest landscape, and this is something that Spot Gamma do very well, and I'm a partner of theirs, and we're collaborating, we're doing stuff together.
Yeah.
And basically, I keep an eye on that because that helps guide me as to where the potential gravity spots will be. And the reason why you have gravity and why I'm using this word is because when option dealers find themselves long a lot of options, and generally that happens on call strikes on the upside because people are doing trades like we just said, overwriting trades and things like that to enhance their portfolio yield. What happens is dealers get stuck with a lot of call options. And if the market rallies into those call option strikes, the Greeks on those call options explode, right? And the gamma on those call options, which is the main Greek because it's super short dated options, so gamma tends to be the dominant Greek there, that just absolutely balloons. And all that basically means is that dealers happen to be needing to sell futures when the market goes up, and when it goes down, they buy them back. And that act of buying and selling futures kind of makes it very hard for the market to move, right? Because that's kind of an extra force of buying and selling that is keeping the market pinned, right? It's keeping it around those big strikes, right? So 4,700 was a massive strike on the S&P going into November. And the probability I thought was quite high that we were going to pin around there. So the way I capitalized on that was I sold options. I sold an iron condor structure, which is where you sell a call spread and a put spread and you collect premium. And I sold it so that those options were around that midpoint of 4,700. So the idea was if it stuck at 4,700, I was going to get to collect all that premium. And if it broke away from there, then my losses would be limited in terms of how much I could lose, right? So it was a nice risk reward way to play the pin. That was a high probability scenario, but make sure you sell vol, but you do it in a way where you can't blow yourself up, right? You limit your losses, and that's the experience people do, right? They sell volatility. They're not scared to earn premium and sell volatility, but they know how to limit their losses, right?
That makes a ton of sense. Thank you. Is my interpretation correct that because they were sort of long all those call options and their gamma exploded into expiry, that they were long gamma as a function of that? Like how do we determine whether or not the dealer community is long gamma in and around a particular strike or a particular
Well, the easiest way to tell if the street's long gamma is if the market can't move, right?
yeah.
If the market can't move and you are seeing, what were we seeing, right? We were seeing a rotation under the surface. We're seeing horrible breadth. Literally, Tesla, Apple, and Nvidia were the only stocks rallying, right? Everything else rolling over, right? Yet the market can't move away from the strike and realize it's falling off a cliff, right? So you're seeing that clearly the street must be choking on gamma because the realized kind of gives you a read on that. But then what was surprising was that the VIX was kind of not collapsing, right? The VIX was kind of holding its level. And I think that was partly due to the fact that cross-asset vol was going up, right? So you had rates vol going up, and that's been stubbornly allowed to go too much lower because of that cross-asset vol dynamic. But the market just couldn't shake off the pin. And so as soon as the pin goes away, you saw more intraday volatility on the Monday than you saw the whole of the previous week because the pin's gone away, right? So the market's shown you that that's what was going on. And now, obviously, we had VIX pop from around 17 up to 19, 20. It's starting to catch up to other cross-asset volatilities. It might still have some ways to go because, you've got year-end. Maybe there's been a bit less supply of vol than you'd normally get into an expiry because people want some hedges over year-end or something like that. But these are the type of things that are stopping the VIX from collapsing right now. If the market kind of manages to find a level, not collapse from this, because there's a bit of a volatility trigger, as spot gamma like to call it, where the where the street flips from being long gamma to net short gamma. And that often can trigger a bit of acceleration to the downside and a bit more of a VIX spike, basically, right?
So is the reason for this is, again, I'm still at a 3, so hopefully I'm asking questions to educate myself, but hopefully everyone else is appreciating the sort of rudimentary level of these questions. But why is it that the level of the VIX or the level of volatility, implied volatility, is a determining factor for whether the street is long or short gamma?
Well, it's more you get a feel for if the VIX is expensive, for example, right? If it's way above realized, then why is it way above realized? Because people are short, basically, okay, and they don't want to sell any more and get even shorter. They're like limit short, basically, right? If vols are compressed, then it's because everyone's long. So you saw November optionality get completely crushed because everyone was long November, right? But the VIX doesn't represent November volatility that everyone's long. The VIX represents December volatility, plus it represents particularly downside volatility, right? So something that we've seen certainly over the last year and a half since COVID is that the spread of the VIX, and what the VIX represents is like the 1 month volatility, but spread across all the strikes, okay? Particularly weighted to the downside. It's replicating what we call a variance swap, okay? So the VIX level replicates what we call a variance swap, and that variance swap, you could think of it as a weighted average of all of the volatility across the 1 month options, across all strikes, but the weighting is skewed to the downside, okay? So if there's no one selling those variance swaps and there's no one selling those puts, then that VIX level is going to be much higher than the at the money vol level. The at the money vol level right now might be 14. The VIX is at closer to 20, right? So that's a 5 to 6 vol point spread between the VIX and the at the money vol. Whereas in a normal world, we had a lot of supply of variance swaps before pre-COVID, before they all blew themselves to smithereens, that spread was closer to 3 vols, right? So you've seen that extension of that spread because you've taken a load of supply of downside out of the market that was systematically coming to harvest that risk premium. They're not allowed to do it anymore, basically, right? So it's too recent a history of how much money they managed to blow up in that period that they've stopped doing it, basically. Now they're going to come back in a couple of selling vol swaps. I remember trading in 2005 and 6. Vol swaps were just getting crushed, like so many sellers, to the point where the spread between at the money vol and variance was like a vol point. It was the tightest ever. It was crazy tight. And then they all blew up in 2008, and then the spread massively widened, right? And it took ages for it to compress again, basically. So you get these cycles, just like you get macro cycles, you get cycles in vol dynamics, right? You get cycles in supply and demand of certain types of vol products, and these risk premia kind of will trade expensive or cheap depending on those supply and demand imbalances. Yeah.
And this is how you get structurable markets. I remember in 2013, the beginning of 2013, we took out the old housing and S&P 500, and I think we took out some threshold in one in the VIX, but also in the spread between implied and realized vol on a trend on a longer term basis. And it was like, this could be the explosion to the upside that everyone's waiting for. You're going to get the supply of vol back into the market. Those types of hedge fund strategies are really going to come back in vogue. So I guess if you're super long-term bullish, that's certainly that spread, that massive premium there. It does represent an opportunity for other players to come back into the game and start to sell ball again. Transition. So this one that was outstanding. Thank you for all those insights. Transition this to the Q&A a little bit. We got one from, and by the way, if you guys have questions, it's obviously dump into the chat. We'll try to get to as many as we can before the end of the show. So starting with the first question from my man John Charlesworth. How you doing, John? It says, how do you deal with huge option bid-ask spreads when getting into and out of options? Sometimes it's 10+%. Do you just place your orders at the mid price?
Yeah, I mean, I personally try not to trade too many options that have really liquid and wide markets, basically. So I prefer to stick to the more liquid instruments. So that's kind of how I deal with it. Stick to what trades tight, right? So, ETFs that have really liquid options markets, like the likes of GLD, SPYs, Qs, things like that, they're fine, right? But when you're going to some random single stocks that have got really wide bid offers, yeah, unless I've got a really structural longer term position view. So I'll give you an example, right? Like I quite like the uranium story. I don't mind the cannabis story as well. These are a couple of longer term narratives that are there and I can see playing out over time. But the options markets aren't amazingly tight, right? So I go for longer dated stuff that is going to be is not going to be a trade that I need to manage very much, right? I can just fire, forget, leave it alone, stick my price in at mid. If I get filled, great. If I don't, okay. But I'm not going to need to manage that, and it's not going to decay away in the short period of time. It's on there for a year or whatever. Like I think I did some Jan 23 uranium and cannabis call spreads actually, right? MSOS and URA, and I did those just because the risk reward of owning those call spreads relative to owning the delta and being stopped out, it made more sense to just park some capital in those call spreads, and they're going to pay you 3-to-1, 4-to-1 on your capital if you get that longer term rally, and you don't have to really even watch the market in the short term because, my God, the price action in MSOS has been horrendous, right?
Uranium, nat gas, MSOS, those things are not for the faint of heart, man. And this is why I keep telling people, I'm like, look, I'm bullish. I think the market's going higher, but we have a very high beta portfolio construction. Like there's a lot of risk in this portfolio construction relative to a broader market index. So we definitely want to have some cash to mitigate that. And obviously the bonds offset that to some degree, or certainly.
Yeah. I mean, I had the uranium from a nice entry point, but I chose to stock replace it. So what I did, I ran up that long and then I converted it into a longer term call spread to then allow me to take that money off the table and then just be in that call spread, let it run via that call spread, and know that I don't need to worry about stopping out of my delta, basically.
This is excellent, man. This is really good. Keeping it moving there with the queue. Got Larry Baxter, our good friend of the program, great friend of the
yeah, I saw your interview with him. It was
he's awesome. Yeah, one of the best people out there that has certainly been blessed to come into my life. Mr. Larry's asking, specifically, how do you utilize options, delta option spread for two scenarios? One, protect the ticker at the top end of the proper range. We talked about that call overriding. And then two, use a call or spread to go along with better capital efficiency or have a max loss. I think that's probably a better one for a discussion.
Yeah, so there's two. I mean, on the hedging side, obviously we talked about selling calls, but you can also buy puts with the money that you collect from those calls, right? Yeah. So that would be if you had a bit more conviction that not just that we're going to stall, but we're actually going to pull back and correct significantly, then you would buy the put with the money that you collected from selling the call, and that's called a risk reversal or a collar. And yeah, I do periodically do that in markets that I feel are overstretched. Now, in terms of speculating and trying to go long optionality to play a breakout or something like that, I'm of the mindset that you want to buy yourself time, basically, right? and the joke that in our last discussion about short dated options being the graveyard of capital, and it kind of is, because you're so sensitive to you getting the timing bang on, basically, right? Because when you buy a short dated option, a week, 2 weeks, 3 weeks, whatever it is, it's decaying at such a fast rate. If you don't get that move and get it fast, the decay just eats you up. And then even if you get the move a bit later in the day, towards the end of that expiry, it just never makes any money, right? So the way you counteract that is, when you want to play an actual directional move using long options, you either buy longer dated options, right? That maybe 3 months out, okay? And the counter to that might be, yeah, but they cost way more money. But you don't have to run them, you don't have to keep them until their expiry, right? You can buy a 3 month option and hold it for a month and then reevaluate, right? But the decay bleed on it is going to be a lot less, basically, right? So that's one way of thinking about it. And another way is to do spreads. So you do a call spread or a put spread. Put spreads are particularly effective to be bearish, and the reason why is because skew in equities is to the downside, right? So that means when you buy, like, you might buy 98% of current spot, you might get 2% out of the money put, and you might sell a put 5% further out of the money, right? So it'd be a 5% wide put spread or something. And the vol that you're selling that downside put on is so much more expensive. So that means the carry profile, the decay profile of that put spread is really quite nice. So the put spread, whilst it can make 5% if you just smash through both strikes, it might only cost you 1% of premium. So you're still getting a 5-to-1 leverage on that put spread, right? But if nothing happens or the market just trades sideways, the bleed you're going to experience on that put spread isn't going to be as dramatic and as fast as if you just bought the outright put, basically, right? Yeah. And then the last kicker to that is, say you buy a put spread that's maybe 3 months out, right? 3 month expiry put spread. Maybe it's a 95-85 put spread, something like that. You're trying to protect that proper drawdown, basically, right? And over the course of the next month, the market starts to top out and slowly go down, right? But it doesn't accelerate, but it starts to slowly go down. You might be able to buy back that 85% put for cheaper or the same price that you sold it, but not to have that high conviction when you first did the trade. You put your hedge on, but you did a hedge that would carry itself well, buy you some time. As your sort of view gets confirmed, we start rolling over, then you say, now I don't want to be short that 85 put anymore, buy it back. It probably hasn't changed in price because the decay on it's been so heavy, and now you've got your 95% put protecting you all the way to zero, basically, right? So those are ways. I think the mistake people who don't trade options or haven't traded options for a living are, they think when they do an option trade, they are stuck with that. They are married to that trade till expiry, right? That is not the case. You can change your option, you can restructure it, you can do all sorts with it throughout the life of that option. And it's once you understand how that premium behaves through time and space, i.e. spot, then you really know how to utilize options to their full potential.
Absolutely, man. Two things I wrote down in my head was just make sure it carries itself well and buy yourself time. You don't need to be in a hurry. Obviously, we have probable range processes. There's a lot of folks with trading range type processes that generally are more accurate, and the whole point of the word probable is that it's accurate, but that doesn't necessarily mean that it touches the range and it has to reverse immediately, right? And so that's the key takeaway, is that give yourself some time whenever you're using these types of strategies to risk manage shorter term market fluctuations. All right, keep moving in the queue. Todd's asking, when you use the term gamma, are you meaning the rate of change of an options delta based on a single point move in the delta's price?
Yeah, so the way you define gamma exactly is the change in delta when spot changes.
Yep.
So typically, like the amount of spot change that we talk about is 1%. So if certainly in equities, right? I mean, different asset classes might quantify it slightly differently, but we say, how much does the delta of the option change when spot moves by 1%? Mm-hmm. That's how we define gamma.
Sounds good. And then Eric, Greg, we saw your question on gamma. We talked about that at length. So in case you joined us late, check out the replay. Eric's asking, Eric Warner, thanks for joining us. With new 5-year options on SPX on the S&P 500, does that offer a good opportunity if the market sees a real decline. Are you looking at this, and is there any perspective you can share?
5 year options.
These, yeah, I guess there's some new 5 year options on the S&P
Yeah, I
500.
mean, I'll be honest, right? I don't trade longer than a year generally in terms
Yeah,
of optionality. And the problem with 5 year is that certainly in Europe and Asia, and probably to some extent the US, a lot of that flow is dominated by big players like structured products guys or some big insurance companies. So the behavior that you'll get in those long term options, because once you understand options and the Greeks, you understand that a long-term option is much more vaguer than it is anything else, basically. Okay, right? So how that? I mean, obviously it's going to have delta on it, but you can neutralize that delta or whatever, right? So you can express that delta view via a future or something. But the 5 year option, the Greek that it really has is Vega. Okay, so the destiny of that option is going to be determined by what happens to the implied vol in that 5 year part of the curve, and that's going to be completely supply and demand driven, right? So are there a bunch of structured product guys who just issued loads of products that need to sell $10 million of Vega? That's what's going to matter for the long end. Basically, it doesn't matter what the market's realizing. Doesn't matter where the market's going. What matters is the flows. And I think being a retail guy, you're so out of touch with those flows, and you're never going to have that transparency. You're better off staying the hell out of it, in my opinion.
that's I say that all the time. All right, so question, I guess, for me. So, how much do deteriorating COVID conditions actually affect the production constraints that are in part driving goods inflation? So, very much, they very much impact them, as we've been discussing in our macro, or sort of in our macro scouting report decks. I'm looking for that chart now. My apologies. That is slide 64. My apologies. Here we go. So this is something we've been talking about. So let's just take a step back. Okay, where are we in this sort of supply chain dynamic discussion? Based on our analysis, we're looking at a few things as proxies for to quantify supply chain dynamics, and more importantly, quantify the change in supply chain dynamics, because it's not the fact that they exist, the change that really matters to markets. And with the sort of four metrics we've been really anchoring on, the 2 year break even, that obviously is very close to a cycle high, a little bit off of the cycle high, but very much still very much signaling that the supply chain disruptions are ongoing. One thing that's been very positive of late is this big drawdown we've seen in the Baltic Dry Index. Obviously, as you know, the cost of shipping, the cost of transporting goods across the world has obviously gone up a tremendous amount in this period. So that we've seen some rates. We've seen freight rates at the Port of Los Angeles, the one in Long Beach. Those are starting to come down as well. So we're starting to see a little bit of amelioration at the margin. The big data points we're going to get next up are at the beginning of next month. We get this ISM ISM manufacturing and ISM services, supplier deliveries, the percentage of the percent of respondents reporting slower delivery times. Those have been really good proxies for supply chain disruptions. I've made the case that, hey, I think we're kind of peaking. I don't. It's very unlikely that the further we go out in time, kind of just looking into the likelihood that we have this deceleration in growth, deceleration in demand, you're going to need a concomitant deceleration in supply chain and supply for that to really kind of not manifest itself in disinflation. And so it's our view that, hey, it's unlikely we see incremental uptick in sort of or incremental downtick in supply as a function of COVID-19 dynamics. Because again, as the question sort of alludes to, a slowdown in COVID-19 might actually depress demand heading into this winter month, particularly once we get outside or beyond, the kind of the goods demand we're going to see in the winter. Once you get beyond that, it's, I've made this joke all the time, or I forget the last time I made the joke or what forum I made the joke, but it's like I own 7 pairs of the same Nike shorts. They're fantastic. They're super comfortable. They're great to sit here and sit in front of my computer all day and wear them. I'm not going to buy an 8th pair. There's only 7 days in the week. I'm not, so I think that's kind of what we're headed into next year as we look out into next year. And I think that's kind of the one big thing I think a lot of investors are missing on this discussion is the fact that we're now starting to see a pickup in inventory building. And that, in our opinion, obviously on a lag, will continue to perpetuate disinflation throughout next year as well. So you guys know where we are on that. Certainly think October, our model currently thinks October was the peak in inflation on a headline CPI basis. I do believe November has the potential to splash itself higher, if only because of the aggressive move higher we saw in the SAR and headline CPI in the month of October. But again, we're talking about a November, October peak in inflation. If we're talking about this a year from now in October or November of 2022, we're going to have inflation about 200 to 300 basis points lower. Pick your metric. So That, in our opinion, is why we're long bonds, and we'll be incrementally getting longer of bonds as we progress into the next part of the year, into the next part of the cycle. Next question here. So Eric's Warner is asking you, Imran, do you roll down a spread the same way you roll down a leap?
Do I roll down a spread the same way? I don't really trade leaps,
Gotcha.
so I'm not sure how I roll down a leap because I don't trade them. But I do. Yeah, rolling options definitely a big part of what I do.
Mhm.
And I'll give you an example of kind of rolling and why I would roll. Right. So recently, probably a couple of months ago, I was quite bullish on Ethereum. Right. And whilst certain people in the market, I won't mention any names, were saying the best way to express a bullish trade on Ethereum is to just buy a load of March upside calls. Okay. Problem with those upside calls is they're on 130 vol, really expensive premium. And if the market ripped 5,000 points on Ethereum, yeah, you're going to do very well on those calls, right? But that's quite a low probability outcome, right? So what I wanted was a trade that would do well in a $1,000 to $2,000 move in Ethereum, just as well, right? And would carry well, right? Like I said, it's about how do I carry the position and get it to do what I want it to do, right? So I was actually selling those really expensive March upside calls, and I was buying shorter dated calls against it. So I was long some October calls closer to the money calls, and I was short some December upsides. I then rolled that into the same trade, but November calls versus March upside. And then as we started to get the rally in Ethereum, it was making money, but those Novembers were getting too close to expiry. They were getting within a couple of weeks to expiry. They'd kind of done their job. They'd gone up in value, but if I just sat on them until expiry, there was a risk that all that premium was going to evaporate. So I wanted to keep the same position, stay bullish, stay long, stay short those really expensive marches. The trade is to roll my November calls because they've gone sub 2-3 week expiry, roll them to deck. So I roll them to December expiry, keep them alive, roll them up a bit in terms of strike, choose the appropriate delta that I wanted to replicate the position that I wanted. But that's what you do. You own a position, but when it starts to get too short dated, that now you're no longer expressing just the delta view, but the timing is becoming paramount now, and it's too binary. You get your move, it's going to explode, but you don't get your move, or you go the opposite way, and your premium is just going to go pop. That's when you want to roll your premium to park it in something that's going to stick around, basically. Yeah.
And so clarifying what you mean by roll is just you're booking that trade and rotating into a further
Yeah, it's
upside.
rotating into a longer expiry, taking
Okay.
that trade off, and we're putting similar type trade, but in a longer expiry with less time decay.
Gotcha. So I assume you have to pay up for that because you're getting that extra time.
Yeah, I mean, it depends on the strikes that you choose and the deltas that you want and that type of thing. That would depend what you pay. But like, I don't necessarily think of all my options trades as in the actual premium being spent in terms of, I think of it in what's the daily carry of the position going to look like, basically, right? What is the daily time decay of running that position rather than what is the net premium outlay or whatever, right? Because I'm not going to run the chances are I'm not going to run that position to expiry anyway, right? So looking at it from a perspective of what is the premium outlay, that's kind of assuming that you're going to hold on to it till expiry, right? That's not necessarily what you're going to do, right?
Gotcha. And then further clarification, you made one comment that I thought was important when you're talking about the vol and the Ethereum calls in March being very expensive. You're saying, oh, that premium is really expensive. Um, how do you determine what is expensive in your process and what is cheap? How do you determine that?
Yeah, so you look at things like historic implieds. So that's like, what is the implied? You can do the same thing for implied vol, right? So you can say typically that's 4 to 5 month volatility on ETH it's high when it's above 120, it's low when it's below 100, whatever it is, and it was at the top of that range basically, right? Yeah, that's the idea.
Brilliant. All right, Denny's asking a question. What are your thoughts on the DXY breakout and the impact on treasuries and risk assets? Taking it to the charts back to the slide deck here on slide 15. So, we made the call to get long the dollar in early June. That's obviously been a good call. Right for the wrong reasons to some degree because we were initially anticipating the D's that we have projected coming in, kind of this part of the curve, certainly over the next 6 months. We thought they would show up a little bit sooner. Obviously, had some forecasts that were on the inflation side to the upside. as have most models. By the way, I got a good question from a brilliant client the other day. He's like, seems like the models missed on inflation to the upside, or inflation's come in a bit above your target over the last couple of months. I said, it's coming a bit above everybody's target over the last couple of months. I don't think anybody's inflation models on Wall Street are programmed with supply chain disruptions and COVID-19. I mean, if you had a model that could nail that, you probably have a model that has not worked in the last decade or two. And so this is why you're seeing the city surprise inflation surprise index is at an all-time high for every economy, because everyone's obviously their models are being surprised, but that's neither here nor there. I just want to bring that up. The key takeaway on the dollar, I think it's being fundamentally driven. You can take it into the back test. So you look at the expected value, the annualized expected return on the dollar is -1 to 3% when you're in Goldilocks and reflation, but you're talking about the economy transitioning to inflation as it has already, and then deflation is the forward outlook for the dollar. You're talking about a 3 to 5% annualized return. So this is something that we think is fundamental as a function of the grid regime process, but it's also fundamental as a function of markets pulling forward the prospect of tightening. And I said this, I'm going to say on the Real Vision interview I did with Tony Greer last week, which I think came out today, and we'll make sure we get that link to subscriber inboxes later today. I said, hey, look, we're dovish on inflation rate of change terms. If you look out, 3 to 6 months, certainly 12 months from now, our model's saying inflation is a sell, and receivers are a buy in that regard. But the reality is, if you look at the actual cadence of the data over the next few months, we have a couple six, like when they're sitting at the December FOMC meeting or the January FOMC meeting, they're going to be looking at a couple six handles on headline CPI. They're obviously going to be now looking at a 4 handle on headline on core PC, which is something I talked about in that discussion last week. I say, look, they're going to have some data that says, hey, 15 billion a month is not the right number. With 15 billion a month, accelerate number 15 to 25 billion when the market regime, when the economy is in reflation, which is again, I do believe we could see an upside surprise in the October, November data as it continues to get reported. If the economy is in inflation, that's bond bearish. Tightening monetary policy, hawkish monetary policy in an accelerating economy, it has been and always will be bond bearish. However, tightening monetary policy into an economy that is trending lower is bond bullish, and that's something we think the yield curve continues to compress as a function of that, and ultimately we think bonds will be a pretty meaningful buy as a function of that, but certainly you might have to get through some more volatile weeks over the next few weeks.
On that trade, Darius, I would say the way I'm playing that bond bullish view, because I kind of agree with you that we're heading into, a slow March 22 in the TLT ETF. Yeah. And the reason I feel more comfortable being in call spreads than just outright is because what if we got this inflation call really wrong? Like you say, what if it way overshoots and the Fed, I don't know, market does start to price in some kind of steepening, right? I don't see it because every time we get hikes priced in, curve flattens more, which is why I'm comfortable with being long the long end. But let's say it does change. I just think people are calling for such a move in rates, given that we are, on the big picture we are quite low. I'd rather be in call spreads than in outright long in that bond space. Basically, if we are going to stay inflationary, it just feels like a more comfortable way to carry along. So I'm doing it via those March call spreads in TLT.
Capping your downside. All right. So last couple of questions before we wrap up. Eric Warner asked a really good question. Said, hi Darius, when you recommend to dollar cost average into a equity or ETF exposure, they're obviously all ETF exposures, how should we think about the time frame to bring it to the full desired position, which I understand to be 4% of net worth based on the slides? That is correct. I tend to think about dollar cost averaging over the course of a couple of weeks. Obviously, in terms of how the probable range process tends to work for most assets, it takes about 3 to 4 weeks to complete an entire cycle. And so if you think about dollar cost averaging over a couple of weeks, that's about half of the cycle. That's about the time it should take to get you into the full position and towards the lower boundary of the probable range. It could obviously take longer, certainly in a raging bull market of something like Bitcoin last Q4, certainly in the most recent couple of months, you might not get the lower boundary, but you always eventually do, as we obviously seen with some of the cryptocurrency exposures in the portfolio construction. Now, getting a very clear buy signal for those of you who have not participated and not gotten in. So don't ask me about them in late December if they're up a lot. And then lastly, great question here, and I'll kind of do a very shameless plug. Is it shameless or shameful? Neither. They're neither. It's neither shameful nor shameless, because I do believe this is going to be a fantastic product and a fantastic solution, one for myself, but for a lot of investors in the in the audience, but they're effectively Todd's asking says he's traded options for years, but still has a long ways to go in terms of knowledge. What path or resources do you recommend to get to the next level?
Okay, so yeah, it's good. It's quite timely, that question. So I'm dropping a brand new course. So historically, I've been running live boot camps and stuff via my website, which is optionsinsight.com, options-insight.com. Those are live on Zoom interactive boot camps, which I run at weekends. But frequency is you got to wait, right? The next one's in January. So feel free to sign up to that, and you'll get me live and live and direct, let's say. But in the meantime, I'm dropping a course with Spot Gamma, which are the partners that we mentioned. They've got a great product of their own that looks at option positioning, and I've helped them create an educational product for their platform, which is called The Hedge. It's an options course dropping on Cyber Monday. It's called The Hedge. It's a 3-part course which will take you from junior trader to senior trader to portfolio manager. And it takes a lot of my options syllabus and knowledge that I give in my courses. It's all pre-recorded, and on top of that, you also get access to a live Q&A with me once a week on a Tuesday, basically, right? So you've got some extra guidance and kind of hand holding and answer any questions you may have, because obviously that's a pre-recorded course. But that hopefully will be a good resource for you if you want to up your knowledge in options.
I can't wait, man. I think it's going to be a great resource for me personally. I think it'll be a great resource for everyone tuning in. And we appreciate you guys for joining us today. I appreciate you, Imran. I look forward to reconnecting, man. This was outstanding. I appreciate it.
Absolute pleasure, as always, Darius. Thanks for having me.
Cheers, guys. Thanks, guys.
See you.